The banking crisis of 2023 was instigated by a run on the Silicon Valley Bank SVB Financial Group, which is now closed. As you will notice here on the fast graph, the last time the stock was quoted was March 13th, 2023. This has been taken over and bailed out by the government. But it was not the only situation. We also had the closing of the Signature Bank of New York. And again, you can see that the last time they traded was March 14th, 2023. And then finally, there is the First Republic Bank of San Francisco, which was also shut down, but it's being essentially bailed out by the likes of Jamie Dimon and JPMorgan. So we have this crisis and these banks have collapsed. But what I want you to notice, even looking at First Republic here, the bank was, a typical pattern you see on fast graphs, but then we had a slight drop in earnings and then a complete collapse of the price because we actually had a run on the bank. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. A very interesting scenario happening right now, as I'm sure most of you are aware of, is this quote-unquote banking crisis of 2023. And it's a very interesting situation because a couple of things I want to point out. Investing in banks is a lot different than investing in companies like Coca-Cola or Apple or Microsoft or McDonald's, or what I would call your traditional C Corps. Banks have their own way of doing business, their own financial statements, and to a great extent, banks and bank success has a lot to do with the faith of the depositors. And, we're going to talk about that a little bit. But what I thought would be interesting for you is I'm going to start out by doing a review of some of the investment grade regional banks because, to hear it and read some of the press, you'd think the whole banking industry is collapsing, and that's really not true, although the prices of most regional banks did get into some stress. So I put together here 26 investment-grade regional banks. These are banks that have BBB minus or higher credit ratings, which are investment grade. And I'm going to just go through these, and I just want you to see them from the perspective of how each of these are faring. It's going to be very cursory. I'm just going to breeze through them very quickly to just kind of give you an overview of what the regional bank situation looks like. And regional banks, by the way, are significantly different than some of your large money center banks and more diversified banks. And that's very, very important because a lot of what's been happening here is companies like Bank of America and JPMorgan and others have stepped up to the plate to kind of protect these industries, and the federal government has also been involved. But what I want you to look at a company like Regions. We'll start with Regions here. It's BBB plus rated. Now, instead of showing you, these banks, a lot of banks went through the problems of excessive lending. Okay, and we're going to talk about that more in this video. This particular banking crisis, which was a real banking crisis, had to do with the banks operating issues that were real. In other words, they were not able to collect on their loans and the bank's earnings and so on were collapsing. Now, since that Great Recession, the banks have really started to function pretty well, actually, these regional banks. And I'm going to go ahead and show you this here on the fast graph. So you can see that their earnings growth has been relatively consistent, a little bit of problem in COVID. But I want you to notice we didn't see with, a healthy regional bank like Regions, we did not see the same issue that we saw with the ones that we, featured in the thing. So I'm going to go through these quickly here and just point out that, a lot of these banks have all had a downdraft in price, but notice the recovery, almost a 10% recovery yesterday on Synovus, which is a, relatively well-known, popular bank. We have Santander. Now, what I want to make the distinction here, look at this bank. This bank has had collapsing operating earnings. They've eliminated their dividends. So this has nothing to do with the current crisis, as much to do with the current operations. I always say it's a market of stocks and not a stock market. And you're going to see that here. You've got Texas Capital Bank shares. They don't pay a dividend, by the way. There's no dividend on this stock. And notice that during COVID, they had a tremendous drop in operating earnings. They did have a flash crash, but then they recovered and the stock price recovered. But they also, fell in sympathy with what happened with Silicon Valley and Signature Bank and so on. Here's Truist Financial. Now, Truist is the largest of the regional banks. And I might add, for disclosure, I'm long Truist. And this one had a big drop, but then they also recovered 9%. But I want you to note, if you look at this graph carefully, what that 9% actually looked like on the recovery. You can barely see it here. It hasn't changed, the real picture of the bank at all as far as the price goes relative to the fundamentals. But the fundamentals look strong here. This is one that I think is probably an interesting, attractive investment. It's yielding over 6%. Again, recovering as a result of, dropping in sympathy. Trustmark is another regional bank that has basically had been relatively unscathed. UMBF Financial did have a big drop in value, but again, it's recovered over 6%. These are yesterday's closes. Valley National Bank hardly had a wiggle. The bank was already undervalued relative to their fundamentals, and the fundamentals look like they're strong going forward. Webster Financial Corp, another one, had very little stress, recovered 7% after, reacting to all the negative news that originally happened. So there you have it. Those are some of what I would call the higher quality regional banks out there. But then you also have the big, large banks, the big banks like, for example, $374 billion diversified bank, JPMorgan Chase, which is all with Jamie Dimon at the helm. The company's already participated. You see very, very little stress in this. In fact, right now, JPMorgan is getting more depositors and more accounts coming into them than they've ever seen. So the banking crisis is real. The banking crisis happened. It primarily affected the regional banks. In most cases, it affected the prices of the regional banks, but not necessarily their fundamental strength. Anyway, that's kind of an overview of the regional banks. This is Chuck Carnevale again. What I've done to try to bring some light into this, I've asked Professor Nathan Mauck, our associate who works with us at FastGraphs in our money management firm, as a consultant. I had him do a little video here to kind of explain this situation for you. So right now I'd like to turn this over to Nathan and let him present this short video to kind of explain how banking works and what the financial banking crisis was all about.
Wanted to give a little background about what's been going on with bank stocks in the banking sector. So a lot of the news and excitement started with Silicon Valley Bank, which you can see here on the fast graphs, had a precipitous drop-off in price, and then the last trading day was March 13th. So this video is being recorded on March 21st. But there are no more trading days because Silicon Valley Bank was taken over by regulators. So what happened here was depositors in Silicon Valley Bank became concerned that their uninsured deposits were at risk because they thought Silicon Valley Bank was at risk of failing. And the uninsured deposits refers to the FDIC insures deposits up to $250,000. Anything over $250,000 is not insured. So about 80% of the deposits at Silicon Valley Bank were of the uninsured variety, mostly businesses, some wealthy individuals as well. So when word got out to depositors that Silicon Valley Bank could be at risk of failing, folks demanded their deposits back. And this run on the bank forced regulators to step in and close the bank. Regulators also guaranteed that depositors would be made whole, so the investors in Silicon Valley Bank not being protected and the debt holders not being protected, but the depositors being protected. And what was happening with Silicon Valley Bank that spooked investors was that they had a need to raise capital, and this concerned investors. The reason for the need to raise capital was because part of Silicon Valley Bank's capital and liquidity is in bonds. And as interest rates go up, bond prices go down. So the value of Silicon Valley Bank's bonds went down. This created a gap between where their liquidity and capital is at and where it needed to be. So they went to raise capital. But really, it's an interesting case because fundamentally, not anything really off with Silicon Valley Bank in terms of the way we normally think about banking crises. Like if we think back to 2007, 8, 9, that period, it was driven by bad loans. That was driven by banks not being able to collect on the loans that they've made and having bad assets. This is not the case with Silicon Valley Bank or what's happened subsequently. This is really related to the use of bonds like U.S. Treasuries to serve as to meet capital requirements, and then interest rates going up. It's a manageable risk, and it's one that some banks have managed better than others, but it's a very different situation than 2007 and 2008. Well, after Silicon Valley Bank, we saw this spread a little bit, and the next up was Signature Bank. And you'll see the last trading day for Signature Bank was March 14th after a pretty steep drop off. Signature Bank was also taken over by regulators, and those two banks, Silicon Valley Bank and Signature Bank, saw their deposits backed by regulators. And the idea was to stop the spread of panic and to stop depositors from pulling out of these banks. But the market started looking for banks that had some similar characteristics, namely a lot of uninsured deposits. And so you saw some names like First Republic, which has been down majorly. You see a very, very steep drop there. The last trading day here on Fast Graphs showed them down about 47% on that day. This is March 21st, 2023. When the trading day closes today, they're going to finish up for the day by a pretty big amount as plans emerge to really shore up this bank. But we saw other banks like Comerica see a similar drop as the market, we saw them go from about 70 a share to about 44 a share. We saw Pacwest with a similar drop, whereas we saw some bigger banks like Bank of America also see some volatility, but not as steep of a drop-off. So this was really focused on medium-sized banks and banks with a large proportion of uninsured deposits is really what has been going on here. And the story continues to emerge, but this does seem to be a case where fundamentally banks are in pretty good shape. We just had some concern about capital requirements and also these uninsured deposits, and I think the market is still sorting that information out.
Thanks, Nathan. That was really well appreciated. What's happening here in the banking industry, banks operate on faith. Okay, banks actually borrow money from their depositors. When you make a deposit in the bank or buy a CD in the bank, you're actually loaning them money, and that's why they pay you interest on that. Just like if you were buying a bond, or if they were buying a bond from you, they're paying you interest. And also those deposits end up becoming their product, really, if you will, their inventory. But the reality of it is, since they take that money and then lend it out, they actually don't have all the money that depositors have deposited in the bank available 100% of the time. They have to raise money. And with SIVB, as Nathan explained, the company had to sell bonds and they put all their money in treasury bonds. Now, there was some mismanagement there. I do want to be clear about that. They could have hedged their bets. They should have diversified a little better, but they didn't. If they'd have held those bonds to maturity, everything would have been fine. The banks are down in value because the Fed's been raising interest rates. This whole banking crisis now has created a lot of confusion on what the Fed's going to be able to do to control inflation. So there's a lot of turmoil and a lot of flux, and the market's never like that. But at the same time, I don't believe we're looking at the end of the world as we know it, especially the financial world. What I believe is going to happen here is this stuff will all be settled, as it's already started to happen. We'll be getting back to normal, but in every crisis, there represents an opportunity. I think a lot of opportunities have unfolded. The markets have been relatively weak. They were strong yesterday, weak again today. We'll see. So I would be careful with your money. I think buying stocks at good value, especially traditional stocks, is going to be more important than ever. Anyway, I hope you enjoyed this video. We just tried to give you a little bit of insight and color into what's been going on in this banking crisis. I hope you enjoyed it. If you did, ring the bell. Give me a like, if you will. Subscribe to the channel if you haven't already. And also take a look at Fast Graphs. Fast Graphs is really an excellent research tool that can help you make better long-term decisions and focus more on the business behind the stocks that you're investing in. Hope you enjoyed this. We'll talk to you again real soon.